Hi, I'm Dorian Lam, and welcome to Start with the Close in Mind. As an owner of a title company and a seasoned real estate professional, I've seen firsthand how focusing on the close is the key to getting the results you want. What I've learned over the years is that this principle doesn't just apply to real estate, it applies to business, strategy, and life. Each episode, I'll share the tools, insights, and real-world experiences, both the wins and the lessons learned, that have helped me and others achieve our goals. I will also bring on some of the most successful business minds across industries to uncover how they approach deals, decisions, and success by starting with the close in mind. Welcome to Start with the Close in Mind. Let's dive in. Welcome to the next episode of Start with the Close in Mind. I am your host, Dorian Lam, and today we have the privilege of having a friend, Shimon Shkury, who I've known for many years as being professionals in the industry. And I've actually had the opportunity and fortunate ability to work with some of the members on your team. Today, you should listen because Shimon is uniquely positioned to discuss how the New York City market is evolving and how relationships still drive transactions and what it means to approach commercial real estate with foresight and strategy. After all, it is Start with the Close in Mind. What listeners will learn today is how preparation, timing, and relationship management shape deal outcomes and why the most successful brokers think about the closing from day one. So, Shimon, without further ado, welcome to the show. Thank you for joining us.
Thank you. Thank you, Dorian, for having me here. And it's exciting. It's exciting to speak to you. It's exciting to speak to the audience. You and I have known each other for a very long time, since the chip days. And I love that. I love that you're doing it, and I love to be a part of it.
Yeah. If you could give a little background about yourself, your journey, you are a fellow business owner. You founded Ariel
Yes.
Property Advisors. So
Yes.
give us a little bit about your journey before we dive into it.
Sure. I'll tell you a little bit about my history. I grew up in Israel for the first 27 years of my life and came here to do my MBA, which I did at Wharton. Graduated 2 years later and got into investment banking for about 6 months. I got laid off. And that's the first thing that I think when you think about the close, the close in mind, the one thing you always have to think about is how do you structure your mindset? And I think the number one thing for anybody who's successful or want to be successful is build that mindset of trying to look for positive items. And for me, when I got laid off, it was a terrible thing. I was here in America 2 years after graduating business school. It was right after September 11. It wasn't my fault. The tech boom was not there anymore. There were no jobs. And I was, trying to ask myself what good can come out of it. And two major things happened to me, which is really amazing. Again, going back to mindset. Number one is I met my wife, and we're married with 2 kids, very happily married. And I think, people ask me, why'd you come to the United States? What I tell them, I came here for, to pursue my MBA, but spiritually, I really came here to meet my wife.
Yeah.
So that's the number one thing, right? I think that, one of the things that are really important in life is to find the right partner. And number two, the second thing that happened to me is I realized that one of the things and passions I have in life is real estate. So what do I do then? I made a transition from being a banker or consultant into being a real estate broker in commercial real estate, and started at a company called Massey Knackle, which doesn't exist today. It's sold to Cushman and Wakefield. And that was in 2002. And one of the things I did there is going to the second thing. So the first thing is mindset. The second thing is focus. If you remember Massey Knackle, one of their things was territories.
Yes.
And I took a territory focused specifically at the time in East Harlem and realized that there's a tremendous opportunity there because it wasn't Manhattan below 96th Street where it was super competitive. There wasn't enough information back then, 2002, and I could be that information agent. And the third thing that I think was super important for me, again, just looking backwards, is people. I knew that I can do certain things. I knew I wasn't great at certain things. And I knew that if I wanted to grow this, I had to hire the right people. And I did. I was very fortunate to hire 3 people at the time. One is Ivan Petrovich, Matteo Torici, and Victor Sozio. All 3 started with me back at Massey. Today are the three of my founding partners at Ariel Property Advisors, in addition to 3 others that I'll talk about a little later. And the fourth thing that I think is super important in my journey is systems. How do you take successful formulas and try to systematize them? And that's really, I think, the hardest part. But this is more or less my journey. So we started at Massey Knuckle at the time, and we've grown this to be a great 8-person team or so. And somewhere in 2010, 11, decided that we want to branch out. And in January of 2011, started Ariel Property Advisors. And the idea was to create a company that's not just a transactional company, but it's also an information agent. So we created, again, going back to the close in mind, created something that allows to our clients to tap into and have any information they need about New York real estate in their fingertips. So today, we're a 65-person operation with about 30 people that are sales support and research. So almost one-to-one between professionals and support. And we believe that that's a big differentiator when it comes to working in New York City and in general.
Yeah.
In addition to that, so in addition to the 65 people, we have 7 partners. So 4 founding partners, 3 new partners. We have a career progression that allowed people to step up as partners. And the last thing that I'll mention before I'll lead it to you, or the last 2 things, is we started a capital services group in addition to the investment sales about 10 years ago, which is thriving today. It's tremendously successful. The 2 partners I didn't mention are Sean Kelly and Paul McCormick. Paul actually leads that effort with capital services and in general here in the company. And we also branched out of New York City and created a partnership with 6 other offices throughout the United States. That partnership called Global Real Estate Advisors, GREA, which allows us to go out and service our clients and GREA's clients outside of New York City. So I'm going to stop here for a second because I said a lot.
Yeah.
And you can ask more about my journey.
No,
if you
I mean
want.
that's so much. And just to recap very quickly, one of the things you highlighted is people, right? And as a business owner, congratulations first of all to getting the team. I mean, 65. That's really impressive, right? Especially given when you started. So people is a huge thing, and if there's something to be taught, if anyone out there is starting a business or looking to scale in any way, just go straight to people because that's ultimately where you're going to end up.
Absolutely.
You mentioned problem solving, right? So I myself had been laid off as well at some point in my life. And, whereas many people really take that negatively, and I understand why, it really does kind of challenge you to understand either what went wrong and take the feedback, seriously. And it could be outside factors that had nothing to do with your ability. But at the end of the day, you got to figure out what to do. So it's the problem solving aspect of it. And, one thing you coming out of Massey Knuckle, I always use this football analogy. I don't know how closely you watch American football, but there's this term called coaching trees where certain coaches have come off of other coaches. I'd be interested to see what the Massey Knuckle tree looks like at this day and age, because boy, what an impact that, Bob and Paul have made just even after the sale. Just how many of you have really taken the system and the systems, right, to quote something else you said, and really built on that. And then lastly, the wife. Yes, that's the foundation of any man's success. A lot to unload there, but I do want to jump into the local commercial real estate environment here in New York. You've been around now in terms of just seeing cycles, right? So tell us a little bit about the state of the market as we approach the end of the year. Tell us what your outlook is 2026 and compare this to kind of other points in time. Is it different? Is it the same? Is it a little bit of all? Like, what would you say to that?
It's done great for me. So thank you for plugging it in. I think it's important to give credit to people, especially to Bob Knuckle and Paul Massey. I want to talk about the market. You asked a great question. I've been in several cycles, and one of the things people will tell you is no cycle is the same. And this one is not the same either. Here are the good news. The good news are we have more transactions than last year. We see it already in the numbers. If it's going to be 10% higher than the 29 billion that we had last year in terms of investment sales, or 35 billion, it's not clear, but it's going to be higher. And we still want to see where the last quarter falls. And that's good news. That means that things are transacting. And they're transacting because of several things. One of them is mortgage maturities. You have a lot of mortgages that are coming due and people need to act on them. Secondly, it's because of the housing policy. Last year, the state and city put out a housing policy from the state and the city of Yes from the city and some rezoning initiatives from the city. So a lot has happened in the development market, which I'll talk about as well. And lastly, the fundamentals are very strong in certain product types, specifically Class A office and free market multifamily. And then you trickle it down to the different asset classes. And if you look at the office market, the Class A office market is off the charts when it comes to leasing. You see that leasing has been drastically higher compared to the year to companies that are willing to pay north of $100 per foot in many cases. The average is about 85. If you talk to some of our leasing brokers friends, they'll tell you that on 57th Street, there's a penthouse office that is asking about $315 per square foot, which is huge. So the Class A office is doing extremely well from a fundamentals perspective. These are usually companies who want the location, want the amenities, they wanted to retain employees. That's a big perk, especially in the going back to office environment. If you want your people in the office, provide them with the best. There's one more thing when it comes to high-end offices, it's a club. So if you're in the elevator with a hedge fund, you want to see another hedge fund or a tech company that can afford it to be in that building. So Class A is doing exceptionally well from a fundamental perspective. But Class A is doing exceptionally well also from a recap and recapitalization, some sales and refinancing perspective. The prices are still lower than peak, which was about 2018 or definitely pre-2019, but it has grown 10% year over year. So you see the RXRs of the world, and you see SL Green selling 10% of their One Vanderbilt to an international buyer at about $2,000 a foot, about a very high number per foot. And so you see capital coming into that, and RXR recapitalizing some buildings, and Blackstone buying into some buildings with Fisher Brothers, for example. So all of that leads us to believe that the Class A office market is not only in demand, but has a shortage of supply. And lastly, for Class A office building, before I go somewhere else, is there's about 16 million square feet that are in construction right now. Some of it is on spec, some of it is not. So that's super, super interesting. Then in office, you have clearly the Class B and C, which on the pricing wise is not doing that great. You have the discounts there. They're drastic, they're dramatic, but you have buyers. So the two types of buyers that are buying Class B office today are either those who want to retain the building as an office building, reinvest in the building, upgrade it. Maybe they're not going to get the average $85 a foot. They'll get a little less, but that's good enough for them from a longevity perspective in owning it. And the second type of buyers are the office to resi converters.
Yeah.
And this is super interesting because the housing policy affected that in the biggest possible way. In fact, one of my colleagues here at Ariel just the deal on 35th for Marty Berger and Andrew Heiberger. And they've done a tremendous amount of work and managed to get, I think, more than 100 lenders out to look, and about a fifth of them actually gave us a bid. So it was very, very, a lot of appetite because of the housing policy. The other thing that we've seen there is clearly the Midtown rezoning, which was the need for that conversion. So the city did well when it comes to office conversions. And then on development, you have a residential rental development, which now has the 485X. And I'll tell you that in terms of the 485X, it's known at this point that it's good for units or buildings that are going to be 99 units and under because of the wage requirement that's above that. So that's something that has to change. But again, it creates some kind of velocity, not enough velocity, and not enough of a dent in residential rental development. When it comes to condos, we've seen some luxury condos taking place in Manhattan. The one that you probably heard about the most, 800 Fifth Avenue, that Naftali bought. They bought it at a pretty big number per buildable,
Yeah.
close to $3,000. And they believe they'll sell at $11,000, and it makes sense. It's right on the park, and so specifically luxury condos are doing well. And then you have the multifamily market. And there you have a bifurcation. I mean, you have like the free market world, you have rent stabilized, you have affordable housing. The free market world, Dorian, is doing the best.
Yeah.
That's where you see rent growth, you see undersupply, consistent undersupply. Just to talk about that, we're told about 500,000 units are going to be missing from the market in 2032. So
Yeah.
we need to build about 50, 60,000 a year. Not there, a third there, maybe half there in good years. So there's a consistent undersupply, which pushes rents up, and that brings in buyers. And there on the free market side, you see newer buildings that are being either recapitalized or being purchased by institutions. Did one of those recently. We've seen Carlisle doing a few of those. We've seen others. You see buildings that are older. You saw JP Morgan buying a building on 43rd from, I believe, Mass Mutual recently for about 700 plus a foot. This is a building that had no tax abatement, older building, but free market rent. So maybe light rehab or light value add is there, but it's super interesting to see. And then you have the smaller buildings that are class 2A and 2B, mostly in Brooklyn and where they're somewhat tax class protected, that are being purchased by mostly private individuals. So the world of free market multi is doing exceptionally well. Affordable housing is a completely different story. It is doing well from a demand perspective. Affordable housing, multifamily. There you see mission-driven capital coming together with operators wanting to invest. They're looking to provide quality housing, quality affordable housing. And, you and I have been traveling in that world a little bit. And what's interesting there is that you want to provide a quality affordable housing and you need to show a return. That's where there's alignment between city, state, and federal and the mission-driven capital, where you can actually develop a building or build a building or preserve a building with a tax abatement, with a Section 8 deal, with some subsidies in many cases. We just sold a building earlier this year in Far Rockaway for Related. Treadway bought it, and they went to the city and got a tax abatement. They extended affordability for many years, and that was an $88 million deal. So we're seeing that as huge demand. The supply side on the affordable world is not always there, just because you have optionality as an owner, so you don't always have to be forced to sell. And lastly, when it comes to rent stabilized housing, that's the market that got hit the most. It's the perfect storm for rent stabilized housing. We see that HSTPA, the Housing Stability and Tenant Protection Act, has hurt it in a detrimental way. You can't increase rents even upon vacancy since 2019. Then you had COVID and collections. Then you had interest rates that jumped from 3 to 6, even 7 in some cases. Now they're down, but they're still double what they were in 2022. You have expense load that's higher, and the result is discounted sellouts of rent stabilized multi, anywhere between 40 to 70%, depending on where it is. So it's a tougher market there. The buyers there are private people for the most part. They are buying because of current cash flow and based on current cash flow, and they're expecting HSTPA to change, which we do as well. It's just not a sustainable regulation. So I said a lot. I covered the office. I covered development. I covered
it all. You gave me true state of the market.
Yeah. Yeah. So I hope it wasn't too much.
No,
but
it's not too much.
Figured.
It's not too much. It's what the audience to hear. They want to hear it from you, definitely not from me. One of the things that I picked up on is, we hear a lot about the supply dynamic, and that it's hard in New York from the developer standpoint. Do you see, you don't have to go in reverse order through or you don't have to go through all the asset classes again, but in general, because you did mention about office, that there is supply coming on. Do you feel that about the other asset classes? Even from the perspective of, multifamily, is it keeping up, or is it at a point where we're just kind of continuing to lag behind with demand?
That's a great question. The answer for multifamily is we're lagging behind, and here's why. The one good item from the housing policy that came out is the extension of the 421A. So if you had footing in the ground, you can still develop the old 421A for a longer period of time, for 2030 or 31 or something like that.
Yeah.
That was great, because you saw few deals, for example, in the Gowanus that were purchased. Charney purchased one of them for, it's 1 million square feet. And that tells you Charney can develop 1 million square feet in the Gowanus because they had the old 421A. Moving forward, though, anybody who wants to develop with a tax abatement is, for the most part, cannot develop more than 99 units, because when you do it above 99 units, the wage requirements are onerous. They're not sustainable. They're not allowing you to have an economic value above 99 units. So that's reason number one why we're lagging behind. And so I would say that if the city was serious about developing rentals, right, and we want to develop rentals, I would change that. I would change the 485X. I would change that wage requirement above 99 units. I mean, I will make it a lot more palatable and more like the old affordable New York, the one that we just missed in 2022.
Yeah.
That's one item, is related to preserving existing rentals. So if you look at the world of rentals, we have about 2 million rental units throughout the city of New York. Half of them are regulated. So half of them are rent stabilized. And when I talk about rent stabilized, not rent stabilized affordable housing, rent stabilized that doesn't have any regulatory agreement. It doesn't have an income requirement, which means that you and I, or anybody who makes good money, can live in it. Meaning it doesn't really serve affordable population or affordable tenancy. It serves as a barrier almost to entry, because you have these suppressed rents. And what it does is the million units that are not rent stabilized are going faster in terms of rent. And that's why you see the enormous growth in rent over the past few years. So one solution is to think about what to do with the 50 or 60,000 vacant units that we have today in the rent stabilized world, and to encourage bringing them up to market, provide a one-time allowance for that. You can stabilize them then at the new market rate. It can still be rent stabilized, but you'll bring up immediately 50, 60,000 units. The other part of it is go back to something that was so smart and so aligned back before 2019. If you have a vacancy, make sure that the landlord can invest in the building and bring up the unit to speed. It's just, these are just ideas, but it's not just about building more. It is about building more. It is also about looking at the inventory that you have today and making it less restricted to bring units up to speed.
Yeah, it's freeing up an existing stock that I'm picking up from you. Is that actually being occupied right now for restrictive reasons or not? Or it sounds also like there's a contingent of people that are just overqualified for the unit. So that's interesting. That honestly doesn't really get that much coverage, right? And it's an important factor. It may not sound like much, but it's 50 to 60,000 units. That's a fair amount.
That's 1 year. I mean, we need 50, 60,000 units a year to make the 500,000 shortage that we're going to have in 2032. That's 1 year, right? And that's just that you can do that like that. Now, people are talking about existing tenants. Existing tenants today, post-HSTPA, existing tenants in rent-stabilized buildings actually live in worse conditions. These buildings, in many cases, are dilapidated. They don't, there's no incentive in investing in them. So, I mean, freeze the rent, don't freeze the rent. At the end of the day, you're living in worse conditions. If you want to provide a great alignment, you want to take any vacant unit that comes to market and encourage landlords to put money into them and bring them up to free market at least one time, so the city can survive.
Yeah, there's an element of quality of life too. It's not so much about just
Correct.
finding a place for someone to stay. You need the quality of life. That's a great point. So let's segue into the capital markets aspect of it. How do you see the capital markets helping to move this along? And given how you have a very good pulse on the market, where are the opportunities?
Let's talk for a second about, you mentioned capital market. Let's talk about lending, because I think that's super interesting. And I'll tell you that in the past year, since the middle of last year, we've seen a flood of new lenders, mostly private lenders, coming to market. Capital services, mortgage brokers are very, very busy in a good way. So anything that's transitional, if you have a development side or semi-development side of semi-vacant building, or a building, like I mentioned, an office conversion, even a hotel, we have transitional lenders. There's a lot of transitional lenders that are willing to play. When it's stabilized assets, be, free market buildings, retail that are income producing, or multifamily that's income producing. You have the CMBS is here in a big way, agency lenders. You have balance sheet lenders as well. So I think the opportunity today is very similar to what I just described in terms of where investors are looking and where lenders are looking. It's mostly in the free market world. And big deals, it's the Class A. And then in development, it's the conversions and some condos in higher end places, as well as rentals, if you can make it work.
Yeah, that's so we're gonna pick up on make it work, right? So what are your tips on making it work, right? We are both in the service of advisory. You more so than I. Obviously, we advise kind of on closing and things to think of up front rather than later. You're not you have the unique perspective of being up in the front lines and also in the back lines, or the end of the kind of cycle where you're moving to a closing. Oftentimes, depending on the market, you're only in the front, you're only in the back. You've covered it all. So making it work, to pick up on that, like what are the insights that you would provide given, your client or anybody that's coming to you? So if I came to you and said, Shimon, I don't know what to do with this piece of property, or maybe it's not even that. What are your tips with regards to what do I need to know before I know?
Yeah, that's the number one question, because I think that one of the things where we can add the most value, or when I tell people in our industry where you can add the most value, is put a hat of an advisor. Put a hat of someone who sits in the shoes of a client. Ask the client exactly what they want to achieve at the end of the day. You're talking about starting with the close in mind. Where do you want to be a year from now? And why? Right? So come to you and say, I want to sell my $20 million building. And they said, did you consider taxes? Is it in a C Corp? Do you know how things, what will you do with the money? And so on. So these are questions you have to ask up front, because some people are super sophisticated and some are not. And so they really have to you have to consider what happens after they close, after the money's in their hands. So I would start there. And once you know what the need is, and the need could be different. It could be strategic need. I want out of this rent stabilized world completely. Or the strategic need is I want to sell this building so I can pay down my loans otherwise, and so on. So that's great. That's a strategic need. Or it could be a family dispute. It could be a, not dispute. It could be a family of 5 kids that just inherited something and they want to just move on with their life. And it could be someone who has an issue with a lender. He has equity or she has equity in the deal. They come in to recapitalize. So the first thing is to understand the client's need. Where are they coming from? What's their need? At the end of the day, are they going to transact? And if they're going to transact, are they going to be happy with that transaction? Once you understand that, the goal of someone like us is to understand values and understand market positioning. And these are the two things that we do first. And we spend a lot of our time and analyst time, and a lot of time with the client before we get hired in many cases, to understand where to take that building, or how to market that building, how to position that asset or portfolio of assets, and why the market is going to perceive them the way they do. In a way, think about us when you come to us. If you decided to sell, and we all know your needs at this point, and let's say it's a sale, think about us as buyers. I tell our people, think that you're the buyer looking at this deal and try to understand what's the reason you're buying it. Sell it to yourself, then put it on paper, then have the pitch ready, and make sure that your diligence, or your due diligence and information checks out.
Yeah.
For example, today, when you sell a building in Manhattan below 96th Street, call it a 500 unit, 100 unit, 50 unit, 70, 80% of the building is free market. The first question is, how is this building converted to free market? When you sell when you ask one of my partners about affordable housing, and he tells you one of the things we need here is all the documentation and understand the regulatory agreements and what happens if, and how can we get a tax abatement, and can we get vouchers here? Can we not get vouchers here? And so you really need to understand the building as a buyer. If you're a mortgage broker in our world, two things you need to understand. One is how a lender looks at it. And secondly, what kind of returns can you provide equity? So I would start with valuing everything first, right? The second thing is positioning and understanding how this asset plays compared to others in the market, and who's going to think about who's going to buy this. Not because, at the end of the day, this is the conversation you're going to have with the client. Then once you're hired, the most important thing where you're going to be the most successful is optionality. Is if you continue to provide options to your clients regularly. Who's willing to buy? How many are you have that are willing to buy? What is the market say? If you're selling $100 million, $50 million deal, and the market tells you consistently it's 40 million, 38 million, it's suddenly you have two outliers at 44. Got to call your client and say, listen, you want to sell today? These are the two you should work with, right? So this is what I'm talking about optionality. Optionality could be, look, someone wants to sell a joint venture. So we might find them the ability to do that. So optionality is really the most important thing. And the last thing I'll tell you, once you chose a horse or several, one of the things you got to do is keep on it to the closing table. Make sure that buyer has all of their due diligence. Keep in touch with them. Make sure that they're getting their ducks in a row. Understand their process. Their process could be, I'm going to two equity providers. I'm putting money down. It's hard, but I'm going to two equity providers. Make sure they have everything they need to sell their deal to the equity provider. By the way, one thing you got to do is communicate with your client consistently and tell them he's got equity from this person, he's got equity from this group, and so on. He's going to finance it this way. We're going to do it, or someone else is going to do it. So the client needs to know every step of the way. But your goal from there on, from the time you chose a horse, is to bring it to closing and make sure that the buyer has everything they need in order to close. So that's more or less what we do and how we do it. But it starts with advisory. You gotta really choose the client consistently and revolve around the client consistently.
Yeah, and you were very thorough on that, and I can relate to that. It's engage with the advisors earlier, right? Sooner rather than later. And I oftentimes get the sense that not that people can't figure it out on their own. Obviously, they are entrepreneurs themselves. They have been able to accomplish deals through time, but even somebody that's considered prolific, it's different. Even if they've done a handful of these, we literally live it every day. Different, interactions and different variations and different, mechanics and givens. So it's one of the things where you can see things way ahead of somebody else, just simply because you've done it before, right? And because you have worked through the process of even offering optionality. I like that, which is, given what you're trying to accomplish, here are your options. You want this, here are your options. Right. You want this, here are your options. And in the exercise of thinking through that, you can kind of figure out what you need in order to accomplish it, right? So as you bring it to a close, it is true. As you pick your horse, like you said, you need to make sure that it's seen through or followed through all the way to the end, because that's generally where we see certain things come up way past, due diligence, contract signing, as you're teeing up for a closing, that sometimes things come up and people are taken by surprise. And obviously there's always surprises in this real estate world of New York, but at the same time, there's certain things that shouldn't really be a surprise, right? Especially if you have the right advisors.
I agree. No, and I think just for us, just going back to systematizing it, if you interviewed here any of my partners, it's Victor Sozio, Mike Tortorici, or Sean Kelly, they all will say the same thing about the process that we implement, or Bench Legal, or Matt Swardlow, or Matt Sabonik, all of which are great, fantastic people here at Ariel. They will all say the same thing about the process, be it financing or be it investment sales. That's the process we ingrain, systematize here at Ariel, and that's super important. So when you have a 65-person operation, it's hard to systematize. We try our best.
Yeah, and you guys are doing a great job. Shimon, I'd like to, wrap up. Thank you so much for joining us today. So today we learned from Shimon how foresight and preparation, especially in this world of real estate, and even in the world of owning a business and founding a business and starting a business, right? Strong relationships, people continue to define success in our marketplace, New York commercial real estate, and in entrepreneurship. So, Shimon, thank you very much. Where can the listeners follow you?
So LinkedIn handle is Shimon Shkury, which is ShimonShkury. I'm reading my own name. LinkedIn, Ariel, Ariel Property Advisors, and Instagram, ArielPA.NYC, and Facebook, Ariel.property.advisors, and X, Ariel _
We'll make sure we'll include all that in the comments. So for those who are trying to write it down, don't worry about it. It'll be in the comments. Check it out. Shimon, thank you very much. I'll see you around.
Thank you, Dorian.
And
Thank you.
I always like to say this. I can add now, if you need an advisor, seek out Shimon and his team. If you need an advisor on the closing side, seek out myself. Always think of the end in mind and always start with the close in mind. Thank you very much, everybody.